All right, those were the headlines that we are tracking for you on the Money Show this all day today on ET Now. Okay, well, first up, let's introduce on the show Devang Shah, Deputy Head of Fixed Income with Axis Mutual Fund. Devang, thank you so much for taking our time and speaking with us today on ET Now. So Devang, to start with, let's talk about all the announcements that have come in from the RBI, the pause on the rates and the whole accommodative stance. How are you reading into all the announcements to start with, just to get some context for our viewers?
So to actually simplify the entire RBI monetary policy, what RBI has done is probably continue with this pause on rates. So they have actually not changed any of the monetary policy rates. All of them continue to be where they are. There's been no change in any kind of repo, reverse repo, CRR rates, anything. I would say the highlights of the monetary policy include, one, the announcement, as you rightly highlighted, about the government, RBI buyout program, which they have called it as the GSEC acquisition program. So that is something I think the entire focus has been on monetary policy and the liquidity management. So whereby they have again tried to focus on the variable reverse repo rate announcements, where they have tried to, I would say, temper with the tenor of these auctions. In simplified format, what they are trying to do is that the entire focus of monetary policy continues to be growth driven. The accommodative stance, where it was probably time bound, where they were trying to keep the accommodative stance till H1 2021, now it is being state based, where what is the actual state of the economy and how does the growth cycle pan out. So as and when they are more convinced about a sustainable recovery on growth, then probably they'll try to withdraw the accommodative stance. That is what is the RBI's message. And the entire liquidity management framework through two perspectives. One is the announcement of these probably the longer term VRR, which we will need more guidelines and they will be announced soon. And the second aspect is about this GSEC acquisition program, which they have announced for Q1, a 1 trillion buyout of GSEC from secondary markets. I think markets on the monetary policy are quite happy, because if you look across at one, they have changed their guidance to be more accommodative. It is a slightly more dovish pause. Secondly, from an aspect of OMO, probably this acquisition plan is kind of an open market operation with more certainty. And RBI has actually reiterated that they might continue with their other liquidity tools also, like open market operations and all, in addition to this 1 trillion of buyout of GSEC from secondary market purchase. So overall, I think it was a very, very positive policy from RBI's perspective, where RBI, whatever the markets were expecting, they have actually given on all fronts. They've given all those aspects to the markets. The VRR announcement of longer tenor might create some bit of, I would say, confusion and probably can lead to a slow and very, very steady gradual rise of the short-term rates. So our perspective is, our expectation was that on a quarterly basis, RBI had started this movement of variable reverse repo of withdrawal of liquidity of 2 lakh crores in January, on January 7th. They would have done a quarterly announcement of increasing that amount from 2 trillion to 4 trillion and probably go to neutral liquidity. RBI, as against that, has announced this longer term tenor VRR, which probably, again, the amount can see some bit of changes there. But I would say, because the messaging from RBI is very clear that they will keep surplus liquidity, plus open market operations will continue, plus this GSEC buyout of 1 lakh crores, they will keep the liquidity surplus. But somewhere down the line, the short end of the curve, the yield should start going up gradually. So I would say what the synopsis of this is, the long bonds will continue to remain supported through open market operations, and the short bonds on the short end of the curve probably will, over a period of time, over the next 3 to 6 months, will gradually start inching up to normalization like pre-COVID levels. So that is how we decode this RBI monetary policy.
Okay, so let's talk a bit more about that big bond purchase program. Devang, it's sort of reminiscent of the big quantitative easing program that was announced. Would you compare it with that? And what could be, and by the way, this is going to be conducted simultaneously with the OMO, etc. So how do you sort of make sense of all of this buying activity, by the RBI? And what would be the impact of that, on yield curve, on long-term interest rates, if especially given the fact that it's a 1 trillion rupee bond buying program?
So, to give you some more perspective here, on a monthly basis, probably what we have is close to 1 to 1.2 trillion of GSEC auctions. Okay, and on a monthly basis, we have probably around 60 to 70,000 crores of SDL auction. So the gross supply which hits market on a monthly basis is close to 1.8 to 1.9 trillion rupees. Now, if I look at a quarterly supply, it's equivalent to something like 6 trillion or 5.5 to 6 trillion. What RBI is going to do is RBI is going to support the market through open market operations, a combination of OT and this GSEC acquisition plan to the tune of 1.2 to 1.5 trillion or probably 1.8 trillion. So one third of the supply probably will be absorbed by RBI. It is a very, very positive step because somewhere down the line, this gives certainty to the markets that yes, 1 lakh crores of fund, this GSEC acquisition program will be conducted. And in addition to that, there will be some OMOs and OTs. But the sheer size of supply is so huge that if supposedly this announcement was not done, probably we would have seen the GSEC yields today only to be close to 6 quarter or 626 quarter levels. So the announcement of and the certainty of this OMOs and GSEC acquisition plan probably puts a kind of I would say cap on yields. Somewhere down the line, the markets for the near term will trade in the range of 6 to 6.25 or 610 to 630 range. But I don't expect significant gains for long bonds. The announcement is positive because it absorbs the supply and somewhere down the line helps sail through the entire borrowing program. But will it lead to huge rally in long bonds? I would say no. It would probably put a cap on each. So that is how we read this.
So in a way, and again, I just want to sort of make sense of all of this for the common man who may be having debt funds. Let's say if somebody has a long duration fund, 2020, that person saw a great rally in their NAV, but 2021, those gains have been more or less capped. In fact, just in these last 3 months, most of the returns are in the red. So would these announcements at least put a cap, or a floor rather, on the fall in these NAVs or the yields, as we say?
So our view is that probably we all understand that we have near the end of the rate cut cycle. And at this point of time, what best suits the investors is the shorter end of the curve. The long bond space generally makes sense when you are having an outlook on growth, which is significantly weaker. You have a falling inflation, and that augurs well for the rate cycle. Today, I think we are at the bottom of the interest rate cycle, and RBI is probably waiting for more clarity and surety on the growth cycle before the reversal. So at this point of time, what our thoughts are that for long bonds, probably you should, if an investor is already invested, he should book profits. Or if an investor is he's lying to add, I would say he should take to the short end of the curve. He should not be adding investments in the long bonds, because in the next 6 months or so, looking at various aspects, one on the inflation, I think inflation projections, if you look at, they have not changed significantly, just a minor upside on the inflation projections for RBI. But if you look at the trend, core inflation continues to remain very sticky. If you look at the growth trajectory also, yes, we have announcement of certain states on lockdowns, but these are not as stringent lockdowns as it was last year. So the growth cycle might see some bit of mark, but we are not seeing such a huge downturn in growth. Hence, rate cuts looks very, very limited. In that aspect, I would say investors should continue to stick on to fresh investments in short end of the curve only. Probably ultra short term funds makes the most sense for investors at this point of time, analyzing the macro environment and the rate cycle.
All right. So just to summarize everything that, Devang just said for the benefit of our viewers, firstly, those investors who already have long duration bonds or, long duration debt funds in their portfolio, it may perhaps be a good time to book profits. If you are a new investor looking for an opportunity in the debt market, then you should consider picking a short duration fund rather than a long duration fund, or an ultra short term fund. These are the options that Devang believes could be good investment opportunities for this year: the ultra short term fund as well as the short duration fund within the entire umbrella of debt funds. I want to know, Devang, what is your opinion on gilt funds as well? Given all that we've been seeing, this is one category of debt funds that consistently for the last 3 years has managed to give double-digit returns. So what is your take on gilt funds?
Sure. So I would say again, see, gilt funds, why we have got such phenomenal returns is because the last 2 years since the NBFC crisis, which started in 2018, we have had significantly impact on growth cycle. We have had 2-3 years of significantly lower growth, and which again is very, very positive for the interest rate cycle. Most of the long duration gilt funds generally at that point of time will run long durations, and hence the benefit of the interest rate cycle is already in prices. Today, if I look at the industry data, what we look at March numbers or February end numbers, we believe generally all the gilt funds currently are running significantly lower durations. I think the average duration for a gilt fund today would be closer to around 3 years or so. So for an investor who just wants to park money as safety and probably look at a tax-free kind of a return, yes, gilt funds who are actively managing it and who are running lower duration, they can continue investing in them. But from a perspective on return expectations, I think it should be very clear that probably for the next 12-18 months, with such low interest rates, today the operative rate is at 335. Your 1 year treasury bill rates are at 375. Your 2 year, 3 year GSEC are at around 475 levels. So double-digit return expectations from gilt funds, I would say it will be very, very difficult. For this year on fixed income, I would say it will be a year of preservation of returns and protection of investor returns. So that is how we look at fixed income cycle for 2021-22.
All right. Okay. So that's about that. And what about bond funds? The reason why I ask you about bond funds is because I would like to also compare them with the other fixed income instruments out there. One of the most commonly used one is, a bank FD. Many of these financial institutions and banks have started to slowly, very slowly, I might add, increase their interest rates. HDFC Limited did that, and some of these banks as well started doing that very slowly from December onwards. How do you see a corporate bond fund or a bond fund board compared to an FD? Do you see the bond fund give a better alpha? Because we have seen and we've read as well about a lot of these companies having to raise money at a very high rate. Pardon me, they've issued papers at very high rates. So does that bode better for a bond fund?
So I would not be able to comment on fixed deposit rates, but I would say that how an investor should look at allocating to debt funds. So if supposedly at this point of time he has certain allocation in debt funds, which are the best suited funds, I would say he should stick around with the lower end of the curve, because yes, RBI is dovish, RBI is supporting the liquidity, RBI is quite accommodative till the growth cycle shows sustainability. But somewhere down the line, we need to understand, looking at global environment, looking at the commodity cycle, looking at yields globally, I think everywhere we have started seeing reversal. Somewhere down the line, you have also started seeing inflation pick up. Core inflation continues to remain sticky. Growth cycle is not significantly marred, and we don't expect that to be significantly marred in the near term. Hence, RBI should also start seeing, we will see reversal of the extraordinary measures, as well as we will also start seeing reversal of the rate cycle in the next 12-18 months. So for an investor at this point of time on fixed income, the allocation should be to the short end of the curve. I think ultra short-term strategies, corporate bonds generally run lower duration and 2 year, 3 year kind of durations, which are generally very, again, AAA centric, because the SEBI mandate of the fund is to run 80% plus AA plus and above rated assets. So corporate bonds, short-term funds, ultra short-term funds augurs well for investors which are running lower duration at this point of time. Long bond funds, investors who are running 5-year, 7-year, 10-year duration at this point of time, I would say avoid, because we can see the reset of interest rates soon, and hence investors can have some mark-to-market volatilities there. So longer term funds at this point of time, we are not advising clients unless and until his view is 5-7 years on or longer on the interest rate cycle. If it's a short-term investment horizon or up to 1 to 2 years, the investment advice at this point of time is to stick to the short end of the curve.
Okay, all right. So that's just the overall advice coming in then from Devang for investors as a whole on what you should do to and how you should essentially make sense of all the announcements made by, announced by the RBI and apply it to your investment strategy, your mutual fund strategy from your own, how to sort of capitalize on and foresee any sort of movement in the yield curve. Devang, of course, has said that while these announcements by the RBI will perhaps put a floor on the NAVs, or rather a cap on the yields, on the long-term yields, it would not really cause yields to fall very drastically. Yesterday, there was a drop seen in the yield after the RBI announced that 1 trillion rupee bond buying program, but it was a reactionary thing in nature. If you do have long duration bonds, now would be a good time to perhaps consider booking some profits right now. And also if you're a new investor, a short duration fund, an ultra short duration fund, these would be some good investment strategies. Of course, if you may say that, but I'm a long-term investor, I want to invest for the long term. Well, for that purpose, you have equities and you have equity mutual funds. So if you want to park your money for the short term, and you don't want to use a savings account or an FD, an ultra short duration fund or a short term debt fund is a great place right now, as Devang has suggested as a strategy to park your money. And of course, if you're a long term investor, then things I think are a little more easier for you, because you can just buy into an equity mutual fund, start your SIPs, and just sit tight. Well, Devang, I think with that we are out of time as well. So I really appreciate you joining us today on the Money Show, and just helping our viewers as well make sense of everything that the RBI has as well announced. And I hope that post this conversation, they are able to make sense of all the headlines coming out from the RBI and apply it to their own money management skills.
Thank you. Take care. Bye.